All right, so our last chapter was just concentrating on why we have financial accounting, like why does accounting exist, and some basic foundational concepts. And then today we're going to actually start doing journal entries and creating what's called a trial balance. Okay. So how do transactions get recorded? We looked at some examples of some journal entries last week. We touched on those and we talked about the fact that different accounts that we use to track different categories of transactions have different natural balances, whether they're a debit or a credit balance. And we talked about how assets tend to live with a debit balance, and liabilities and owner's equity or stockholders' equity tend to have a natural credit balance. Okay. And so we're going to be applying that in practice to a lot more types of business transactions this week. And then we are going to be creating what's called a trial balance. So a trial balance is a list of all of the accounts that we have within our business. So all the asset accounts, all the liability accounts, all the stockholders' equity accounts, which include our revenues and expenses for the current financial statement period. And we're going to talk about sorting more examples of different types of transactions into those accounts and creating the trial balance. And then that trial balance is basically just like the list of where we stockpile all the information, the summary information. And then the balances that we have at the end of a financial statement period, whether it's a month or a quarter or a year. We take the ending balances of each of those accounts in the trial balance, and then we plug them into the financial statements that we discussed at the end of last week. So does anyone remember any of the names of those financial statements that we talked about on Friday? Yes. Yep, income statement. Yep, so that's where we track all of our revenues, expenses, gains, and losses. And that tells us whether our equity basically increased or decreased based on our organization's operations, right? So anyone remember any of the other financial statements? Yes. Yes, owner's equity. Yep, so the owner's equity then takes what we had for equity at the beginning of the period. It adds in any other infusions of equity, like if somebody invested more cash into the business as an owner. And it also includes the net income that we arrived at the end of our income statement. And then it includes withdrawals of owner equity as well, to tell us what was our equity at the beginning, what was the activity that went through there, and then what was the equity at the end. Anyone think of another financial statement?
Statement of cash flows.
Statement of cash flows, yes. So that one starts with our beginning balance of cash at the start of our financial statement period. And it looks at how our operations, our investing, and our financing activities affected our cash balance during the year. And then it arrives at the ending cash balance at the end. And both of those should tie out to the cash balance that we see on which last financial statement. Yes. Yeah, balance sheet. So the balance sheet encompasses that accounting equation. It gives us our assets, typically at the top, and then it gives us our liabilities and stockholders' equity, generally at the bottom. Sometimes you'll see them in a side-by-side format where the assets will be on the left and then the liabilities and equity will be on the right. But for the most part, you tend to see it in a vertical format. And then you might have what's called a comparative balance sheet where you have like the current year and then the prior year so that people can kind of look at those and compare this year versus last year. All right, awesome. So sounds like everybody's remembering what we talked about last week, so that's great. All right, so we're going to talk now about this recording process that we've got here. So the things in general, what we're going to talk about for this chapter We're going to talk about how we use these accounts to record business transactions, how journals are used, and then how a ledger is used to post and record all of this information. And then finally, how to prepare a trial balance. So a little bit of this will be review, because we actually did talk a little bit about making journal entries last week, but we're just going to get more practice at it this week until everybody is pretty comfortable with how that process works and how to pull those balances in at the end. So we're going to work with T accounts again. If you remember when I was showing you how balances came about last week, I drew some of those T accounts for cash and whatnot. So if you look in this packet here that I posted, which I will also put out on Brightspace if anyone needs to reprint it or whatever. If you flip through there, you'll see there's an example of a trial balance. There's some items here where you can record some transactions and their debits and credits. The third page, it shows here, there's like a list of some accounts, and we're supposed to figure out, okay, what's the normal balance? Is there a debit? Is there a credit? There's a list of transactions and some journal entries and various different formats that we could use for organizing this information. So, and which one was it that had one of these had some T accounts on it somewhere? I thought I printed one that had the T accounts on it. Oh yeah. Yeah, so there, and then there's one page here that's got some example T accounts on it too. So now in future chapters, I probably won't be printing quite so many handouts. You'll, probably be taking notes in your notebook or whatever. But I just wanted to make sure everybody had some examples here for this week. Okay, did anybody have any questions on the homework from chapter 1 before we get rolling, or anything you are getting stuck on? Okay. Okay, so just a quick reminder here of when we are making our journal entries, when we've got these T accounts, and I can put this up on the board here as well, but it's out here in this thing. So we've got a T account here. We're going to have the account name. And we've got on the left, we're going to have debits, and on the right, we're going to have credits. And then we may have a beginning balance, which could either be a debit or credit beginning balance, depending on what type of account it is. So like an asset would have a natural debit balance. So the beginning balance would probably be a debit. And then we could have debits and credits on the same account during the period, right? So like cash, some things increase your cash and some things decrease your cash during the month when you're, doing your financial activities and have your various transactions going on. And then at the end, hopefully if it's cash, you're going to end up with a debit balance at the end, because that means you still have cash left in your account. What does it mean if you've got a credit balance in your cash account at the end? Means you've probably overdrawn your checking account, or you forgot to record some deposits or something. Like maybe you went to the bank and brought something to the bank and you didn't record it in your accounting system. We hope that's the case and you don't have a negative cash balance, right? That'd be a bummer, but it is possible. All right, so and then just as a quick review here, when we have assets, they typically are going to have a debit natural balance, so they're going to be on this left, and then we have liabilities and stockholders equity, typically going to be a credit. And I'll leave that up on the board here so that you can glance up here if you forget, but try to internalize that a little bit if you possibly can, because the faster you can get that just automatic, the easier it'll be. All right, and then we talked about how it's a double entry accounting system last week, where you every transaction, the debits and the credits have to be equal, right? So there has to be at least one debit and at least one credit for every transaction you record. They could both be asset accounts that are getting debited and credited. So you could be like crediting cash because you bought something and then debiting equipment, another asset. So it doesn't always have to be like an asset and a liability or an asset and an equity account. It could be all assets. You could also have two liability accounts, right? Like, so let's say you had a loan and you went out and refinanced your loan. Maybe you debited one loan to close it out and then credited a new one that you took out, right? Or maybe you took out a loan to pay off a business credit card or something, right? So you changed it from a short-term debt into a long-term debt. As long as your debits equal your credits, there's a lot of different kinds of combinations that we could see here for these transactions. All right, so when we are looking at these T accounts, this is a good example here that shows for cash. It started out with a $15,000 balance, and then there were $7,000 worth of withdrawals that went on here for large items, and then a few other things that went on, and then the net balance at the end was $8,050. So if we're going to figure out what is our overall cash balance here, the debits would all be positive increases to cash on the left here, and then the credits would be decreases. So when we're adding it up calculator wise, it's going to look like this. All right. So just remembering that when you are trying to figure out what the end balance is of an account, you need to know, okay, what was the beginning balance? Was that the natural balance for this account? So the beginning balance here was $15,000, and it's a debit balance, which is the normal balance for cash to have a debit balance, positive balance. And then we had a variety of things that increase and decrease our cash during the period. So subtracting the 7,000, adding the 1,200, minus subtracting the 1,700, adding the 1,500, etc., to get to our end balance. And I know this is kind of repetitive, but unfortunately there's not a super easy way to learn this. But this slide right here is a good cheat slide. So if you need to like have a reference, this slide 6 is a really good one. I would recommend maybe just writing this down, or like you could grab one of these sheets and write this down really quick. And it tells you, hint here, what the normal balance is. And then this could actually say liabilities and stockholders' equity here also. All right, I'll give 1 second here in case anyone wants to write that down. Okay, and then here they have, they actually have a separate slide here for the owner's capital. Same format here for owner's capital, like capital investments. And then they have owner drawings here. They don't specifically call this out here on this slide, but on the next one, they'll show you for revenues and expenses, how this works. So I do like here that they have a separate slide for revenues and expenses. These are going to ultimately feed into our owner's capital, but it's handy to just have this broken out separately. So revenues have a normal credit balance because they increase our equity at the end of the day, which has a normal credit balance. And then our expenses have a debit normal balance because they decrease our equity over time. Okay, so then this slide actually has everything all in one slide, which is kind of handy too. So it's got the accounting equation at the top, and then all of the subsections as well. So we talked about this a little bit in the last chapter. All right, so which balances normally have debit balances? Just trying to recall off the top of your head for 1 second before you check your notes. Or the board. So that, yes. Let's see, so we've got assets, owner's drawing, and expenses. Yep, so assets have a normal balance. That's probably the easiest one here. Since owner's equity has a credit balance, anything that reduces your owner's equity would have a debit balance. So yeah, so draws and expenses both reduce that owner's equity, so would be a debit balance. Okay, so let's go ahead and just walk through this, pull out a piece of paper, and we'll talk through this one here, all right? So we've got Kate Brown. She rented space in a shopping mall where she's going to operate a beauty salon. And somebody who knows her has said, you know what, you need to set up a double entry accounting system so you can do your accounting correctly. And we're going to talk about what balance sheet accounts we would probably want to use to record our transactions. And then also what would be the normal balance of each of these accounts, okay? So what do you think? Go ahead and just brainstorm with the person next to you or somebody around you and think, all right, well, what kinds of transactions do you think Kate's gonna have? And what do we think we would need for accounts, right? So think about assets, liabilities, owner's equity, then also think about revenues and expenses, okay? And then we'll come together as a group here and go through what people came up with.
So.
We'll make a list.
Got my.
So I know expenses. Yeah, right. Right. And that's good stuff. She's now this week. Service.
$100% houses. Okay, so just right about the balance sheet account. Okay, so you're gonna need a equipment account. Basically everything right here. Supplies, you have accounts payable. Service revenue. Yeah. If she's opening it by herself, I don't think she'll need doesn't need to pay anyone. Yeah, I don't think she needs, she's opening it by herself. Because it is not a corporation, not a partnership. God, I wish I had that else. Yes.
I'm supposed to know all of this.
Proprietorship, okay. So she won't need to pay anybody because it's proprietorship. She will need to pay rent. Yeah. So that's service. I didn't think it's service. What they got. Yeah. Oh, it's a I do have. That was the difference between supplies and.
Yes.
I have a question. What's the difference between a supply with an account?
So supplies would be like small items that you would use around your office. It's things like paper and boxes of pens and those things that you will eventually use up, whereas equipment would be stuff that you'd probably be using for a
Like
long term.
printers.
Yeah, or furniture or.
Okay,
yeah.
so, she'll have equipment in there. because she can keep track of all her stuff.
Yeah, so for a, yeah, because for a hair salon, yes.
Blow dryers,
Yeah.
blow dryer,
Well, that's
yes. Those weird things that they put.
Yeah, so I like supplies with you. This hair dye.
Hair dye, scissors,
You guys do that on both sides.
different types of, you know, because they sell different types of dough and everything.
All right, so let's take a second here and go through some of these items, some of the things we thought of. So what do you think we might have for assets? Yes, cash, yep, gotta have cash. She's probably gonna need to go buy some stuff, right? And so if she has cash in the business before she starts operating, how would it have had to get there?
Invested.
What do you think? There's a couple ways it could happen, yes.
As like an investment, so that would be like owner's capital, right?
Yep, so owners. Capital or equity, right? What's another way that money could get in there if you started out with no money?
Loans.
A loan, right? So what kind of account would that be?
Liability. right?
Yeah, yep, liability.
Expiring.
So loans payable. Okay, what else do we got? Any other assets anybody came up with?
Oh, equipment.
Equipment, yeah, right? Because you're probably gonna have like some of those special chairs where you can spin people around. Probably gonna have a nice little fixture that you can store all your curling irons in and curling irons and all kinds of stuff, right? So lots of different types of equipment. What are some other assets we might have?
Accounts receivable.
Yeah, accounts receivable. What's another one?
Supplies.
Supplies, yeah. So, yeah, because they probably have, they need to have some shampoo and some different things for doing people's hair, right? Probably also some office type supplies, maybe some paper and pens. What are some other assets that they might have? How do they make money in a salon? What are some different ways they make money? What do we need for that?
Equipment.
Yep, so we got equipment.
Employees.
Sorry, what was that?
Employees.
Oh.
Employees.
Employees, yes. So employees, we don't technically own, but I'm just gonna put this over here, right? Just for now, because this is gonna be something we definitely need for operation, and there will definitely be transactions that we have to record for that, right? Let's see, what do they try to get you to do after you get your hair cut? Well, that too.
Tell you their.
Sell you products, right? So what do we need to have if we're gonna sell products to them?
Services.
Huh?
Services.
Yep, so we're gonna sell services, yep.
Inventory.
Yeah, there we go. That's what I was going for, inventory. So things to sell, so these are ways we're making money over here. I'm just kind of making a note here so we can keep track of that stuff. What are some other liabilities we might run into? You think money that we might owe people for?
Rent.
Rent, yep, so rent payable.
Wages.
Yep, wages payable. And then by that same token, I'm just gonna put here, so revenues, expenses. So we talked about service revenues, right? And product sale, I'll put sales revenues here. For the things that we would sell, and we talked about the wages expense. So now we've got this covered. We've got these covered. Let's see here. What if we're like a little more mature as a company and we have a bunch of cash sitting in there that doesn't need to be in the business anymore? What might we want to do as an owner? What's that?
Safe.
Yep, so, but we might wanna have money, right? We might wanna take some money out. So, owner, draws. All right. So that's pretty comprehensive. Let's see if there's any that they came up with here that we might have missed. Let's see here. So they've got cash, supplies, equipment, notes payable, accounts payable. So those are kind of similar. Accounts payable, we didn't really put that on here. That would be these would be things like, you could potentially have your rent and your accounts payable, but maybe like utilities, inventory, invoices that we haven't yet paid. So like we bought inventory from somebody, but we haven't paid them for it yet. Things like that. So stuff that you typically pay for within 30 days and might be just incurring regularly throughout the course of your business, right? All right, so that's a lot of those. Yeah, so good job, everybody. Lots of good ideas there. And as elementary as that might seem to go through that exercise, you would be surprised how many times I actually had to do that for people when I was working as a public accountant, right? So working as an external accountant where somebody pays me to help them get their accounting system set up. You talk through with them like, okay, what do your business processes look like? But so you can get more information if there's some, less common accounts you might need. But things like the accounts we came up with would be account types that you'd see in a lot of different types of businesses, super common. So you might almost just throw all those in there by default if you were putting together an accounting system for someone. And then you can always delete accounts later if you don't need them, if you've got too many. And then some accounting systems will actually have like a sample trial balance that you can start off with and just adapt as needed. QuickBooks has some types of accounts like that as well. Okay, so the process that we go through as we are getting ready to come up with these with your accounting system and make these journal entries. First, we have to analyze what's going on, which is kind of the step we just went through. We probably wouldn't normally have to do that much analysis if we already have our accounting system set up, because we'd already have those accounts out there. But we would look at a transaction that happened and we'd say, okay, what accounts are going to be affected by this transaction that just happened? And then we're going to come up with a journal entry to record it. Once that journal entry is put together, we do what's called posting it out into each account so that we have a list of journal entries and we can trace the balances in those journal entries once they are posted out into each of the T accounts and see where they flow to. So the general steps in this process are we analyze the transaction, we enter the transaction into a journal in our system, and a journal being like a list of all the transactions that have happened by date order. And then we transfer the journal information out of that list of transactions and into the accounts. All right, so journals are essentially record books. Now we refer to these as books because way back before computers existed, they actually had huge ledger books where they would be able to like insert extra pages in the books as needed, and they would track all of this on paper. All right. And when we look at, if you pull out this handout that I gave you, and you look at like the bottom of the second sheet where it says account titles, debit and credit, pages upon pages of that with handwritten journal entries in them. And so just a list of all the transactions that would happen, right? And then further back in this book, so you'd have your journal book, you'd have another book that was your ledger book that would have pages for each individual account. And after you wrote the transaction in the journal book, you'd also handwrite it into each of the accounts where the balances went through. What do you think is problematic with that system? Where do we start, right? But what do you think is an inherent problem with having paper books like that? Yes.
You could lose them or destroy them easily. I mean, not easily, but
Yeah, right, like somebody dumps some paint thinner on a desk or something, or let's say you have a beauty salon and somebody dumps a bottle of nail polish remover on your books. Suddenly all your ink dissolves and there goes your accounting system, right? Gone. Okay, so very subject to loss, or if you get a fire or something, you could lose a lot of records. What's another problem just from a human standpoint?
it's handwritten.
It's handwritten, right? And therefore subject to what? Huh? Tampering, yeah. And also just mistakes, right? So you write your journal entries here and then you're in a hurry and you go to transfer it into your journal and you put something in the debit column instead of the credit column. And then you go on your merry way. And then when you come and add everything up at the end, it doesn't add up, right? And this is, you're doing this at the end of the month and maybe you're just like, oh my gosh, I have 30 days worth of transactions here and now I have to painstakingly go through them all and figure out where I wrote something wrong. Or maybe you wrote everything in there correctly, but at the end of the month, when you go to add it up, you swap some digits as you're adding things up. And so it looks like you screwed the whole thing up, but you didn't, but now you don't know where you made your mistake, right? So extremely time consuming, inefficient, prone to error. Now, however, we have computerized systems, which are awesome because, I mean, you could do it in Excel, right? Like you could set up all these exact same types of documents in Excel if you hated yourself. And because you'd still have all the same potential for errors, but at least you could like grab a whole column and total it up, right, correctly, very easily and efficiently. But you'd still potentially have transferring back and forth type errors and whatnot. So we have established really good computer systems that will at least say, hey, your debits and your credits don't add up. Could you still do a journal entry backwards? Yes, but easier to find, easier to fix. And once you fix it, it'll automatically flow it through to all of your financial systems and everywhere it needs to go without you having to manually go through and trace it all through. So, so we've got these journals. All right, going back to our journals. We're going to include in our journal, everything is by date and time order. So every new journal goes on a new line in there. You can search on a computer system. You can search by date. So you could say, hey, I know I paid this. The check was issued on, the 15th of January. Let me see a list of all the transactions that we recorded on the 15th of January. So you can go back there and pull that stuff out more easily. And then it's nice because the journal records, okay, you typically would label the journal entries you make and say, hey, this is why I made this entry. So you can go to one place and say, okay, here's all the accounts that were in the entry I made, and here's why I made the entry. So it's sort of a source of truth for you. All right. So when we make these journal entries, they're going to be in this format here. We're going to have, see how we put the debit accounts first, followed by any accounts that are getting credited, and then we indent them a little bit so that those entries can be, you can visually see here whether it should be a debit or a credit. And then over here, of course, debits are on the left, credits are on the right. Sometimes you will see a single column format in a journal where debits will appear as positives and credits will appear as negatives, but most of the time you see this format. And for this class, we'll almost strictly be doing it left to right, just to help make it easier to differentiate between debits versus like increasing an account or decreasing it. Okay, so now this is what's called a compound entry. Notice there's two credit accounts here. We went through an example of this on Friday where I was saying, hey, you could enter in, like if you're putting new cash into your business and you had some money that came from a loan and you had some money that came from personal funds that you're putting into your business. So you could potentially debit and or credit more than one account in conjunction in one journal entry. So in this entry, we're buying some equipment, partially with cash and partially with a payable. So we debited our equipment for $14,000, and then we credited cash for the $8,000 in cash that was paid, and then $6,000 for the remaining part that we still owe them for. Okay. All right, so let's see here. So if you pull out, if you go to the second page that's labeled Do It 2.1 and 2.2 at the top. This one, you can use this to record 3 journal entries here on the bottom. So go ahead and take a second here and take a stab at how to record these journal entries. And feel free to talk to people around you if you're not sure of whether something should be debits or credits. So there's a couple things you're going to want to watch out for as you look at these entries. Okay. So first you want to say, okay, what are the accounts involved? Next, you want to say, is that account increasing or decreasing? All right. If you are increasing an account, then you need to say, all right, what is the normal balance or natural balance for that account? Because that's what I would need to do to increase that account. And if I'm decreasing it, I would just do the opposite. Okay. So up here, I do have listed the default natural balances up here, which were on that earlier slide we had, right? So assets, natural balance of debit, liabilities and equity, natural balance of credit. Revenues have a natural balance of credit, and then expenses have a natural balance of debit, right? So take a minute and take a stab at number 1 there, and then we'll talk through that one first.
And so money would be a debit.
Okay, so we've got here, I'm just gonna pull up Excel really quick here.
Yeah. That's what I'm saying. So 20 grand is-
Darn it, I forgot to do that. Okay, hold on. All right, well, it'll be on the screen here in a second. Okay, so we've got what accounts are going to be affected here? For number 1.
Owner's capital.
Yep, owner's capital because it's her own money. And then what is the bank account going to be? What type of account is a bank account at the under? Cash, right?
Yeah.
Yeah, so we're gonna, and then what is gonna be the account that gets debited here then? For our journal entry, we're gonna have a debit and a credit. We've got cash and we've got owner's equity. So which one gets to be the debit? Cash, yeah, okay, perfect. All right, and then for number 2, we're purchasing equipment on account. So are we using cash here? We're not, right? That phrase on account tips us off that we're not paying cash out for this right now. We're gonna owe somebody for this. And it says it's gonna be paid in 30 days. So that tells us that this is something that is gonna be short term. And so it's not gonna be a loan. Loans are typically longer term. So what type of account do we use to show liabilities that we expect to pay, usually in under 30 days? Yeah.
Would it be payable, accounts payable?
Yeah, accounts payable. Yep. So, and then equipment, right? So, which one are we gonna debit and which one are we gonna credit?
Credit.
No, credit, you credit, accounts payable and debit.
Yeah, so the liabilities are credits and then the assets would be debited, right? So the equipment then is gonna be a debit, which would be on the left, in the left column, and then the accounts payable would be a credit, which would be on the right. And I'll show you how it should all appear in a second. So go ahead and write it down on your sheet, how you think it should look. And then we'll look at the answer in just a second. And then the last one, we interviewed 3 people for the position of hairstylist. So does this require a journal entry? It doesn't, right? Because we didn't have any economic transaction or change of financial position for us at all. So that one, we would not make a journal entry. Okay, so looking at that, we've got cash and owner's capital and equipment and accounts payable, and then no entry because there's no transaction there.